Hello, it's Dale Beaumont here and I'm with Kathy Ewers from Ink Wealth. And in this video, we're going to talk about the 5 different loan types and which one is right for you. Keep watching. Okay, Kathy, so we have 5 different loan types. This is what you have to explain to people constantly. So we're going to do it all right now. So what are the 5 different types? What's type number 1?
Okay, so type number 1 would be your standard variable.
So what is a standard variable?
It's a variable rate that fluctuates with the cash rate increases from the Reserve Bank or with the bank increasing. So basically a variable rate will fluctuate up and down.
And so when you see that rates have gone up, then you'll be paying more. If rates go down, you'll be paying less. Pretty much you're now at the forces of supply and demand. Is that right?
Absolutely. So a variable rate is the most flexible type of rate. It doesn't lock you into anything.
Why do you say it's flexible? Yeah.
Well, you're not locked in like a fixed rate. It offers, you can pay lump sums off a flexible rate without being penalised. You can have an offset account attached to a standard variable rate, and that's one of the big advantages.
Okay, so it's called a standard variable, is that
Yes.
right? Okay, What's number 2?
Number 2 would be fixed rates. So fixed rates are a term that you can choose, generally between 1 and 5 years, and you can lock it in for that period of time, and you are signing a contract to say that you're locking it in for that period of time, and there's big break costs involved if you sell that property or close that loan down within that fixed period.
So what would the standard terms be? You said you could have 1 year, you could have 2, 3, 4, 5, or 10? What's the approximate?
Generally, it's between 1 and 5 years.
1 and 5 years, okay.
Probably the most popular rates for clients are the 2 and 3 year.
And so when you'd want to move to fixed, if you believe that rates are going to go up and you want to lock in a lower rate, that's what you probably should do, right?
Yes, very, very much to do with economics when you're locking in a fixed rate. So at the moment, our economics are that the fixed rates are the lowest that they've ever been. So you would definitely, as part of your strategy, consider locking in all or a portion of your loan as a fixed rate.
Okay, but the flip side is if you lock in and rates drop even further, then you're going to be paying more than you could be paying. So it is a bit of a risk, but it can be a calculated one if you can see where the future's going.
It is a calculated risk. Right now, you wouldn't bother trying to pick the bottom of the market. So if we look at historical rates over the last, say, 10 years, it's right down here compared to there. So right now, it's pretty much a sure bet that you should consider it. It does need to be part of your strategy. So talk to your broker because there's definitely times that you won't fix and times that you do. So it is something that you need to consult your broker.
All right, loan type number 3, what is it?
The number 3 is a line of credit. So a line of credit is a facility that the bank will lend you and it has a limit that you can borrow up to. It's actually a fully functioning transaction account. So it can have a check account attached, FPOS, credit and debit. You can withdraw funds up to the limit and back down and you'll only pay interest on the funds that you've drawn. It's generally a 25-year loan term and it's an interest-only facility.
So that's number 3. Let's go on to number 4.
Right, so this is a type of loan. So in other words, we have a choice now of whether you want your loan to be principal and interest. So principal and interest means you are paying down every month, a principal of your loan will reduce down, plus the interest that the bank is charging you for having that facility. So that's the number 4.
Okay, and then what is number 5?
That would be interest only. So interest only is where you're not actually reducing your home loan down. You are just paying for the interest of the loan. Generally, the maximum interest only period is 5 years. And it used to be where you can roll that over for another 5 years. And now a lot of the banks, it's a full application to get a further 5-year interest only period.
Okay, great. So there we have 5 different options. So then now the $1 million question, how do we know which one of these 5 is the right one for us?
Yes, okay, so good question. It's a very, very personal question. So in conjunction with your broker, you can discuss through the different factors of why you would choose one of those. Basically, there's a few things that go towards making the decision. First of all, it's the economics of where the interest rates are. So are the interest rates high at the moment or are they low? So in other words, do we think they're going to go up or do we think they're going to come down? The type of property you're buying, is it an owner-occupied property or is it an investment property? How long you're going to stay into that property, and also whether you want the facility of an offset account. So because that's a big way to save on your home loan. So at the moment, we're doing a lot of split loans whereby the clients are locking in a large portion of their loan and then they've got a small standard variable split with an offset account so that they've kind of got the best of both worlds.
And I think at the end of the day, it's just about having a chat and talking about your personal circumstances, right?
Yes, it is.
So people can really get in touch.
Yeah, absolutely.
All right. Thanks so much for watching this video. For more information on your next step, just keep watching.
If you want to discuss your financial needs with someone you can trust, visit inkwealth.com.au and claim your obligation-free 15-minute phone consultation today.